something strange happened inside one of the world's most secretive financial meetings last spring. A group of senior analysts, people whose job is literally to track every whisper of price movement across every major commodity market on Earth, went completely silent. Not because there was nothing to say, but because what they were looking at on the screen in front of them didn't make sense. At least, not yet. The number staring back at them wasn't just a price, it was a signal. A signal that, according to decades of historical pattern analysis, has only appeared 4 times in the last 100 years. And every single time it appeared before, within 18 months, the price of silver did something most people in that room still struggle to say out loud. It exploded. And right now, quietly, without much fanfare from mainstream financial media, that same signal is flashing again. The number is $92. And before this video is over, you're going to understand exactly what that number means. Why banks are suddenly playing it very cool in public, and why the decisions ordinary Americans make about their money in the next few months could be the most consequential ones they make this decade. Stay with me, because this story goes so much deeper than a price chart. Let's start with a little history, because the best way to understand where something is going is to understand where it has been, and more importantly, to understand the forces that moved it there. Silver has been a form of real money for over 5,000 years. Long before paper currency, before central banks, before digital trading floors, silver was the metal that ordinary people trusted. Not gold, which was often reserved for kings and governments. Silver was the people's metal. It was used to settle debts, pay wages, purchase land, and store generational wealth across cultures on every continent. And that history matters today more than most people realize, because the relationship between silver's price and the broader financial system is not random. It follows patterns, deep, almost geological patterns, that have been studied by some of the sharpest financial minds in the world. Now, before we go further, if you're new to this channel, I want to ask you to hit that like button right now and subscribe if you haven't already. We break down complex financial stories into clear, honest narratives. No hype, no noise. Just the real picture. Hit subscribe and turn on notifications so you never miss a story like this one. Okay, back to the signal. To understand the $92 silver signal, you need to understand something called the gold to silver ratio. If you've never heard of this term before, don't worry. By the end of this video, you'll have a better grasp of it than most people on Wall Street pretend to have. The gold to silver ratio is simply the number that tells you how many ounces of silver it would take to buy 1 ounce of gold at current market prices. So if gold is trading at $9,000 an ounce and silver is at $90 an ounce, the ratio would be 100 to 1. Makes sense, right? Now here's where it gets fascinating. Throughout most of recorded history, going back thousands of years, this ratio hovered somewhere between 15 and 20 to 1, 15 ounces of silver to buy 1 ounce of gold. That was the natural equilibrium that the market found again and again across centuries. Roman law actually codified it at around 12 to 1. And the United States government formally set it at 15 to 1 when it was establishing the value of the dollar under the Coinage Act of 1792. So why does that ancient number matter today? Because right now, as you're watching this video, that ratio is sitting at roughly 85 to 1. 85 ounces of silver to buy 1 ounce of gold. That means by every historical standard, by thousands of years of market equilibrium, silver is extraordinarily undervalued relative to gold. And when that ratio gets stretched this far, history shows it always snaps back, always. The question is never if, the question is when. And the $92 figure is the price target that multiple independent analysts, using completely different methodologies, keep arriving at as the first major correction point if silver simply returns toward its long-term historical average ratio. Let that sink in for a second. Not some crazy speculative moonshot number, just a return toward historical norms. Now here's where the story starts to get genuinely interesting. Because the gold to silver ratio alone, as powerful as it is, isn't the whole picture. It's just the foundation. Layered on top of that, we have a set of industrial and macroeconomic factors that have never existed before in the history of silver markets. And this is the part that the banks are being very, very quiet about. Silver is no longer just a monetary metal. It hasn't been for a long time. Today, silver is one of the most critical industrial materials on the planet, and its demand profile has completely transformed in the last decade. We're talking about solar panels, electric vehicles, semiconductors, medical equipment, water purification systems, 5G infrastructure, and emerging technologies that most people haven't even heard of yet. A single solar panel contains roughly 20 grams of silver. A single electric vehicle uses somewhere between 25 and 50 grams of silver in its components. The United States alone is committed to deploying hundreds of millions of solar panels and tens of millions of electric vehicles over the coming decade. And those numbers don't account for what China, Europe, India, and the rest of the world are doing simultaneously. The Silver Institute, which tracks global supply and demand data more rigorously than almost any other organization, has projected that industrial demand for silver will hit record highs for the third consecutive year. Record. 3 years in a row. And that demand isn't slowing down, it's accelerating. Now layer on top of that the supply side of the equation. Silver is not mined the way most people imagine. Only about 30% of silver production comes from dedicated silver mines. The other 70% is extracted as a byproduct from mining for other metals, copper, zinc, lead, gold, which means when those other metal markets slow down or when mines face operational challenges, silver supply doesn't automatically adjust. It gets pinched. And right now, several major silver producing regions are facing exactly those kinds of challenges. Mexico, which is the world's largest silver producing country, has been dealing with a combination of regulatory changes, energy policy shifts, and logistical constraints that are putting real pressure on output. Peru, the second largest producer, has experienced significant social and political disruptions at some of its most productive mining regions. These aren't theoretical future risks. These are current, documented supply constraints happening right now against a backdrop of surging demand. So we have historically elevated gold to silver ratio, we have record industrial demand, we have constricted supply, and we have something else. Something that ties all of this together in a way that makes the $92 signal feel not like speculation, but like gravity. We have the behavior of central banks and institutional investors. And this is where the story takes a turn that most people watching this video have never heard explain this clearly before. Central banks around the world have been buying gold at a pace not seen since the Bretton Woods era. In 2022 and 2023, global central bank gold purchases hit numbers that shocked even veteran gold market analysts. China alone has been adding gold to its reserves consistently, month after month, in a manner that suggests a very deliberate long-term strategy. Russia, Turkey, India, Poland, Singapore, the list of nations quietly, methodically accumulating gold reads like a geopolitical map of the emerging multipolar world. Now ask yourself a simple question. If the people who run the world's monetary systems, the people who understand money at its deepest structural level, are buying gold with this kind of intensity, what does that tell you about their confidence in the current system? What does it tell you about where they think things are headed? And here's the follow-on question that almost nobody asks. If gold is being accumulated at this pace, and the gold to silver ratio is this extended, what happens to silver when the broader institutional reappraisal of hard assets begins to include it? Because historically, every single time there has been a major gold bull run, silver doesn't just follow, it outperforms, sometimes dramatically. In the 1970s, when gold rose roughly 24 times in value, silver rose roughly 36 times. In the 2008 to 2011 cycle, gold approximately doubled from its pre-crisis lows. Silver roughly quintupled. The pattern is remarkably consistent. Silver starts slow, silver gets ignored, and then silver moves faster and harder than almost any other asset class on Earth. The question is always the same. Do you know the pattern before it happens, or do you find out about it after? This is the exact moment in the pattern that sophisticated observers are pointing to right now. And the $92 figure, that number that was sitting on the screen in that quiet meeting room, represents what analysts describe as the first technical resistance level, which is basically the first meaningful ceiling that silver would need to break through on its way to a full historical normalization of the gold to silver ratio. If that ratio merely returned to its 50-year average of around 60 to 1, not the ancient historical average, just the modern 50-year average, silver would need to be trading somewhere around $150 at today's gold price. If it returned to the pre-Nixon shock average of around 30 to 1, we'd be looking at silver north of $300. These aren't numbers pulled from thin air. These are straightforward mathematical outcomes of ratio reversion at current gold prices. Now, I want to take a moment to talk about something that might seem like a detour, but is actually absolutely central to this story. I want to talk about the US dollar and why its current situation has a direct bearing on why the $92 silver signal matters as urgently as it does right now, at this specific moment in time. The United States dollar has been the world's reserve currency since the Bretton Woods Agreement of 1944. That status has given the United States extraordinary financial privileges, the ability to run large deficits, to export inflation, to settle global trade in its own currency. But that status has never been guaranteed forever. It was always conditional. And the conditions that supported it are under more pressure today than at any point since the early 1970s, when President Nixon ended the dollar's convertibility to gold and fundamentally changed the nature of money for the entire world. The U.S. national debt has now crossed $34 trillion. Let me put that in perspective. That actually means something. If you spent $1 million every single day starting from the birth of Jesus Christ to this very moment, you would still have spent less than $1 trillion. The US is carrying 34 of those, and it's adding to that number at a rate that, according to the Congressional Budget Office's own projections, is not sustainable on its current trajectory. Interest payments on the national debt are now the single largest expenditure item in the federal budget, larger than defense, larger than Medicare, larger than Social Security. The government is, in the most literal financial sense, paying interest on interest. Now, I'm not telling you this to be alarmist. I'm telling you this because it is the exact macroeconomic backdrop against which the silver signal is flashing. When currencies face structural pressure, when debt becomes unsustainable, when faith in the system begins to erode even slightly at the edges, hard assets historically benefit. And of all the hard assets, silver tends to be the most accessible, the most widely available, and the one that most ordinary Americans can actually participate in at scale. You don't need to be wealthy to own silver. A 1-ounce silver coin at today's prices costs between $25 and $30, depending on where you buy it. For the price of a dinner out, an ordinary American family can hold a real physical asset that has survived every monetary system, every empire, every currency collapse in the 5,000 years that humans have been using it as a store of value. That's not nothing. That's actually everything. And yet, here's the tension at the heart of this story. Most Americans have essentially no exposure to silver. According to survey data from multiple financial research organizations, fewer than 10% of American adults own any physical silver at all. And that number has barely moved despite everything that has happened in global financial markets over the past several years. The mainstream financial media rarely covers silver with any depth. Your average financial advisor probably hasn't had a serious conversation about it in years. The big banks certainly aren't broadcasting their views on the upside of silver to their retail clients. And ask yourself why that might be. Banks make their money on the financial products they sell. They make their money on managed funds, on advisory fees, on the financial system as it currently exists, an asset that sits in your hand that needs no bank, no broker, no intermediary, no annual fee. That doesn't serve their business model. Their quiet isn't a conspiracy. It's just a business interest. Let's talk about the people who are not being quiet, because there's a growing and genuinely impressive list of institutional and informed voices that have been sounding the alarm on silver's fundamental valuation for several years now, and whose arguments grow more compelling with each passing quarter. Rick Rule, one of the most respected resource investors of the last half-century, has repeatedly described silver as one of the most compelling risk-reward propositions he has seen in his entire career. Keith Neumeyer, the CEO of First Majestic Silver, one of the world's largest primary silver producers, has been publicly arguing for years that silver is structurally mispriced, and that a fair value based on the economics of extraction and the economics of demand would place the metal dramatically higher than its current trading price. Legendary commodity analysts who correctly called the 2008 financial crisis, the 2020 gold run, and multiple commodity supercycles have been pointing to silver's setup as unusually compelling. These are not perennial optimists who think every asset is always about to moon. These are careful, experienced, often contrarian analysts who have been right when it counted most. So why hasn't silver moved yet if all these fundamental forces are aligned? That is the most important question in this story, and it deserves a real answer. The honest answer is that silver's price is disproportionately influenced by paper trading in the futures market, particularly on the COMEX exchange in New York, relative to the physical market. What that means in plain English is that an enormous amount of silver trading happens through contracts that represent silver but are often never settled with actual physical metal. This creates a situation where the paper price can diverge significantly from what the physical supply-demand fundamentals would naturally suggest. Large financial institutions hold massive short positions, essentially bets that silver prices will fall in these futures markets. And because of the size and leverage these institutions can employ, they have historically been able to suppress silver's price, even when fundamental conditions pointed strongly upward. This is not a fringe conspiracy theory. It's been documented in regulatory proceedings, acknowledged by former industry insiders, and studied extensively by market structure analysts. The CFTC, the Commodity Futures Trading Commission, has investigated silver market manipulation claims on multiple occasions. JP Morgan Chase actually paid close to $1 billion in penalties in 2020 to settle charges of precious metals market manipulation spanning nearly a decade. $1 billion in a settlement, not a conspiracy theory. A legal settlement with one of the most powerful banks in the world. But here's the thing about suppression. It has limits. Physical markets are real. Industrial demand is real. The solar panels being installed across America, the electric vehicles rolling off production lines, the medical devices being manufactured, they need real silver, not paper contracts. And as physical demand continues to outpace supply, As the disconnect between the paper price and the real-world value becomes too large to maintain, the pressure builds, and when it releases, and history shows it always does, it releases fast. The spring that has been compressed the longest tends to release the hardest. That is the setup for the $92 signal, not a random number from a chart. A convergence point where multiple independent measures of value, the gold to silver ratio, the cost of production, the industrial supply-demand balance, the macroeconomic currency pressure, and the long-term technical price structure, all point to the same general zone. $92 is not a prediction. It's a gravitational pull. The market is not being asked to believe something unlikely. It's being asked to correct towards something historically inevitable. Now, what does this mean for you? For an ordinary American trying to make sense of this? I want to be very clear here. Nothing in this video is financial advice. I am not a licensed financial advisor. What I am is someone who cares about financial literacy, who believes you deserve to hear the full story, and who thinks the mainstream conversation around personal finance too often leaves out the assets and ideas that most directly serve you, rather than the institutions that profit from managing your money. Every financial decision you make should be made in consultation with a qualified professional who understands your individual situation. That said, here is the framework that serious, thoughtful investors have historically used when thinking about silver in a portfolio. Physical silver, coins, rounds, bars, is generally considered a form of financial insurance. Not a speculation, not a get-rich scheme, but insurance. Just as you buy health insurance hoping you never need it, financial insurance in the form of real assets exists to protect you against scenarios you hope don't happen, but that historical evidence suggests eventually always do. Currency debasement, financial system stress, monetary resets, the amount that serious analysts typically discuss as a starting point for hard asset exposure is somewhere between 5 and 15% of investable assets. For some people, that might mean a few $100s. For others, it might mean considerably more. The principle is the same regardless of scale. Diversification into assets that don't depend on the solvency of any institution, the honesty of any government, or the stability of any single currency. Silver mining stocks represent a leveraged way to gain exposure to silver's potential upside, though they carry significantly more risk than physical silver: corporate risk, operational risk, jurisdiction risk. Silver ETFs offer exposure without the responsibility of physical storage, though they introduce counterparty risk and don't offer the same form of direct ownership as holding physical metal. There are genuine trade-offs in every approach, and understanding them is part of what serious financial literacy looks like. The larger point, the one I want you to carry with you when this video ends, is that the $92 silver signal is not really about a price target. It's about a question. The question of whether the financial system as it currently operates, built on ever-expanding debt, on currency creation disconnected from any hard anchor, on markets where paper prices can diverge from physical reality for extended periods, whether that system is truly as stable as the mainstream consensus assumes, and whether you, as someone responsible for your own financial well-being, have thought carefully about what your plan looks like, if the answer to that question is more complicated than the official narrative suggests. The banks are quiet because quiet suits them. The mainstream media is distracted because silver rarely makes for a sensational headline when it's sitting at $28. The financial advisors are focused on the products in their wheelhouse because that's what their business model requires. But the fundamentals don't change because nobody is talking about them. The gold to silver ratio doesn't reset to historical norms because nobody mentioned it on cable news. The industrial demand doesn't soften because your advisor never brought it up. The signal is still flashing. Quietly, clearly, with the kind of patience that markets always have. Because markets don't need to be in a hurry, the fundamentals wait. And here's what I know about the people who tend to benefit most from these kinds of moments in history. It's not the people who react fastest when the price is already moving. It's the people who did their homework before the crowd arrived. It's the people who understood the setup, who made calm, considered decisions while everyone else was distracted by the noise, and who had the patience to let the fundamentals do what fundamentals always eventually do. The ones who paid attention to the signal when it was still quiet. That's exactly the kind of thinking we try to build on this channel. Not panic, not hype, not the next get-rich-quick shortcut. Just careful, clear-eyed financial literacy applied to the stories that actually matter. The stories that the people managing your money hope you're too busy to notice. Before I let you go, I want to ask you something directly. Does this story connect with something you've been thinking about? Have you already started paying attention to silver, to hard assets, to the broader questions about where the dollar and the financial system are headed? Or is this the first time you've heard the full picture laid out like this? Either way, I want to know. Drop a comment below and tell me, do you think silver reaches $92 within the next 18 months? Tell me what you think. The conversation in the comments on this channel is genuinely one of the most thoughtful communities I've seen anywhere on YouTube, and your perspective matters. And if you know someone, a friend, a family member, a coworker, who has been asking questions about where to put their money in a world that feels increasingly uncertain, do them a real favor and share this video with them. Not because it will tell them what to do, but because it will give them the information they deserve to have. A share takes 10 seconds. The conversation it starts could be genuinely important. Hit that share button and let's get this story in front of the people who need it most. The $92 signal is flashing. The banks are quiet. Now you know why. And what you do with that knowledge is entirely up to you.